Hey everybody, welcome back to my channel. I wanted to give you guys a quick update on the inflation numbers and my projections. So the CPI report came out this morning, and sure enough it was right in line with what I was projecting. So if you watched my last video, and I'll post the link into the description there, back on July 8th I had forecasted that based off of the relationship between the consumer price index and the producer price index of final demand goods and services, we should be seeing the inflation rate approach about 5.2 to 5.3% year over year, which would translate to a monthly change of 0.8 to 0.9%. Sure enough, that's exactly what happened. We got in, the inflation numbers came in, they were 0.9%. That was very high, and so that tells you that there's definitely a relationship going on between last month's final demand goods inflation and that coming out into the consumer price inflation, and that should keep going as time goes on. Now this relationship is not perfect, so although I was spot on this month, let me reiterate, I won't be spot on every month. Sometimes I'll be off, and I could be off by a significant margin. I could be off by as much as a 0.5% change in the year over year, plus or minus. So, it's not perfect. It's not an exact science. Forecasting and projecting is really more of an art than it is a science. And that's a key thing. You have to learn how to look past the numbers and the formulas and the calculations to see what the story is telling and if the story makes sense. But for now, it definitely seems to be holding up that we're looking at this. So tomorrow, the producer price inflation numbers are going to come out. Once I get those numbers, I will add those into my tables, and then I will update this model. I will give you guys more of an update, another forecast for next month's CPI tomorrow evening, so that'll be a special treat for you. But I do want to examine here a little bit of the relationship that's going on in the CPI, as well as give you kind of a headlong forward projection. So first off, let's take a look at what happened with the stock market and its reaction. So as I predicted, when the inflation numbers would come out, that would be negative for the stock market. Now, if you notice here, the stock market, this is the Wilshire 5000, by the way, but you can look at the other stock indices, which represent a more narrower slice of the market capitalization of stocks right now for the U.S. Each one of them went negative. But the Wilshire 5000 dropped by 0.5% today, which is not anything extravagantly huge. It was not like a huge drop. And from what I can gather, it probably means that, going in on Monday, investors were, or going in on Tuesday today, investors were kind of bullish on the stock market. Maybe there was some earnings reports that were coming out, or looking forward to high GDP numbers and expectations about reopenings or something, and that was going to put upward pressure on the stock market. It was going to cause the stocks to reach all-time highs, but instead it reversed. Now, one of the interesting things is that the reversal didn't take place right away. So here we are at 9:30, right? So the CPI report comes out at 8:30 a.m. and stocks took a little bit of a nosedive, but they kind of just recovered from their positions, even went positive. And then about 1 o'clock is when the negative attitudes started to take over and push these stocks down. So something happened here, though I know not what. It's as if the investors who were paying attention to inflation numbers were sleeping at the wheel. They just didn't bother to look at the report until 1 o'clock in the afternoon. And then at 1 o'clock in the afternoon, it was like, oh, the numbers are bad, I better dump stocks. And that's exactly what happened. Now, will this trend continue? My guess is that it probably will for the next few days. It probably bounce up and down, but it's not going to take over. This investor negative sentiment is not going to take over just yet and just keep pushing these stocks down. I still think there's room to go, and unfortunately for these investors, this isn't the end of the inflation reports. This is not the final hurrah or the peak of inflation. We're just getting started, and things are going to continue as I'm about to lay out, and I'll show you that in just a few minutes. Now let's take a look at the bond numbers. Well, the bond story is very similar to that of the stock story. So here we are at 9:30, and the bonds were not being dumped, which is represented in higher interest rates, since interest rates on bonds move inversely to their prices. So if the price drops on a bond, the interest rate goes up and vice versa. But look how stable these interest rates were. There was a little bit of an increase in rates, but nothing drastic until about 1 o'clock. And then once 1 o'clock hit, it's like all the investors that were in the bond market that were paying attention to the inflation numbers all woke up at the same time and decided to dump bonds, and we did see a push up in these interest rates. Now my guess is that these push up in interest rates are going to continue, and the reason why I say this is because interest rates have been pushing down for the last month. Really, they have been pushing down for the last 3 months. Ever since they peaked on May 12th, which I find very interesting because this was the time when the CPI first pushed over 4%, and yet investors kind of flocked and tried to push these bonds downward. Now, some of that could have been a negative sentiment towards stocks, so they tried to rush into a safer haven, which I find very interesting. But regardless of which, gold and silver has not been pushed up all that much in the last 3 months, yet bonds prices have. And I expect this reversal to start. I expect bonds to start pushing up and probably reach back to about 1.5, 1.6% for the 10-year treasuries. I mean, nothing extravagant, babe. Nothing extravagant, but yeah, we're probably going to be seeing a little bit of a correction in these bond prices. Now, that being said, how much farther do we have to go? Well, the key thing here, and I'm going to go back to an earlier vid where I was showing you a proper, or at least a more proper way to gauge inflation by comparing it to the money supply and debt over a period of time, is that historically speaking, and for the last 20 years, there has been what I have estimated a 70% confidence interval in the US dollar in relation to the consumer price inflation and the increase in money supply and debt. So what that means is that about every time that during the last 20 years, if we saw both a 100% increase in the money supply and a 100% increase in debt at a 70% confidence interval, that would result in a 30% increase in the consumer price inflation. Now, that being said, we didn't see a 100% increase in consumer, or a 30% increase in consumer price inflation, and that's because your money in debt has not increased by 100%. Instead, your money in debt is increased by 60%, so 1/3 of that is 20%, and that's about what we're seeing right here. Now, all of that being said, right now our confidence interval is high. It's higher than that 70% relationship, even with these new inflation numbers put in. So I've added in the June 30th, and since the end of December 2019, we are still looking at the dollar being unusually strong right now, okay? Now, I believe that this is really more of the effects of money injection. So when money first gets injected into the economy, for reasons that I'm just not going to go into, maybe I'll cover it in a vid, and it's not really important, it doesn't result in an automatic increase in the consumer price inflation, not right away. It usually, there's about a 1 to 2 year lag time. So, it's been about a little bit over a year since the Fed first started printing endless amounts of money, and you can see that in the jump in M2 right here, starting at about, April, right? Say April and May, really beginning at the end of March. You can see the huge jumps in the money supply. I mean, the Fed just injected 15% extra money right there over the course of 3 months. 15% new money created in 3 months. That's unprecedented. That's like a 60% annualized increase in the money supply if the Fed were to continue at that rate. And so now prices are catching up to that Fed injection of money, okay? So we've still got room to go. Now, what were to happen, as I covered in a previous vid, to get back up to this historical 70% confidence interval, what would the inflation rate have to get up to? Well, it's going to have to get up to about 7.5%. So once the inflation rate, the CPI, if it were to catch back up by the end of this year, the CPI could catch up to about 7.5%. That would result in a restoration of the equilibrium of a 70% confidence interval. And note here, that's still a high confidence in the US dollar, right? That's not even showing a low confidence in the U.S. dollar. So I'm giving you guys the low ball estimate, right, of what inflation could get up to. Now, I'm not saying it's going to get up to 7.5% by the end of this year, because you have to take note that these historical relationships are over the course of 10 years, not over the course of 2 years or a year and a half. So it's very possible that this confidence could stay higher, and then we could catch back up next year or in the following years after. But either way, we are looking at high inflation, and despite what's coming out of the official administration's mouth, both on the monetary side and on the fiscal side, it has been the monetary policy that's been pushing this up. Now, fiscal policy has definitely made things worse because of the excess amount of debt creation that's been coming in, particularly since Joe Biden has entered office. But nevertheless, this is really more money driven than anything else. This is really nothing more than the Powell administration pushing money into the system, and Powell can bark all he wants how these are caused by supply bottlenecks and shortages. But Jerome Powell is neglecting to mention to you that yes, we did have a supply crunch that happened last year, but he neglects to mention that he has propped up demand and has created artificial demand in the year coming after that with his money printing. So it's not just that we're having a reduced supply that's driving up prices, it's increased demand along with a reduced supply that's increasing prices. And if we were to hold to that story and narrative, that seems to tell us that we may very well see inflation overshoot this confidence interval. This confidence interval is assuming that, everything goes hunky-dory and there's a stable relationship with the dollar. Well, if what Jerome Powell says is true, that supply bottlenecks are factored into these price increases, then you can kiss goodbye to this 7.5% price inflation by year end, or in other words, 4.5% annual price inflation on the average for 10 years, and you can say hello to these bottom numbers that are substantially higher if he wants to play that route. So no matter what, this is definitely monetary in nature now. It may have been originally supply constraint in nature, but now the monetary forces are beginning to catch over. I believe this trend will continue, and I've just charted this out right here about what the CPI could end up being if it were to catch all the way back up to this confidence level in the dollar. I'm not saying that it will right away. However, what's working for that fulfillment, that we are going to reach this 7.5%, 7.6%, is the producer price index. So the producer price index is historically high. It's at 19% inflation rate. I've just charted this out and used the average and median average to see what it would be like next month. But if we were to follow this and project this out to the end of the year, we're looking at a 22.8% inflation in the producer price indices. And I've also covered this as well in a previous model, the relationship between the producer price index and the consumer price index. And hang on one second, I'm trying to get to that right quick. Here it is. So if you look at this, when producer price inflation numbers are peaking right here, it tends to follow, typically speaking, that the CPI will average about 33% of that producer price inflation, okay? So if the producer price index really does reach 22.8% by the end of year, then logically speaking, that CPI's got to be hovering around 7.6%. So there's really no way of getting out of this. We're definitely looking at higher inflation numbers right now. I'll keep giving you guys updates on this. I'll also lay down outlooks about what I think this is going to do to the gold price, both in the long run and the short run, other precious metals, as well as give you further stock projections and where I think bond interest rates are going to go. So anyways, guys, thanks for watching this video. If you like it, click like on the video and subscribe to my channel. And again, stay tuned, because tomorrow night I will give another update, and it will be with the producer price inflation numbers, and I'll update my projections of where I think the CPI is going to head out for the end of this year. Until then, see you later.